I'm going to create a financial statement for Johnny Depp.
That's correct, sir.
Today, I'm going to be solving a big problem of yours and of many more candidates who frequently try to get into any finance jobs. And they know the advanced stuff like valuation, they understand what is corporate finance, they understand what is trading deflation. However, they still do not actually understand the three financial statements and how they link to each other and how it actually works. In the practical life, ask someone, what is the revenue received in cash if you have a revenue of 1000 but your accounts receivable has increased by 500. Most of them are actually getting confused as to what exactly do I mean.
That's correct, sir.
Before we start off with the actual calculation and I'll show you it in a template, first let me give you an analogy of the three financial statements which probably you'll never forget.
तुम्हारी सैलरी कितनी है?
What?
पर मंथ तुम कितना पैसा कमाते हो?
That how much do you earn in a month? You're basically talking about a specific period. That means you usually ask them how much money do you make in a month or how much do you make in a year. Right? Probably if you are sitting for a marriage is how much what have you done till date, and that's the question related to balance sheet. So
मुझे बता सकते हो कि तुमने ऐसा कौन सा तीर मारा है कि तुम्हारी शादी इतनी धूमधाम से हो रही है?
Balance sheet actually shows you whatever good, bad, ugly you have achieved across years, right? So it's a cumulative question that is coming up, right? So it might be a case where you have earned a lot of money, you have saved a lot of money, so hence your assets are very high. You have been very open about spending money. You have spent money on various non-appreciating assets or things which probably will not add a lot of value in the longer run. And of course, your assets will be lower and your liabilities will be higher, right? So that's the concept of a balance sheet. Now, finally, what is cash flow statement? Since in a year, if let's say even if you're working in a company and let's say you got 15 lakh worth of salary, right? But the problem is that 15 lakh in your income statement will show it as revenue. But there are a lot of other deductions which have to be reduced, right? For example, tax. There might be bonuses which might be deferred. They might not get exactly in the same year. It might go into a next year. And hence we require a statement, a tool, right, which can convert your income statement into three different activities, saying that, okay, this was related to your direct working in a company. So that is your operations, right? Second would be, okay, what investments have you done? Have you got any income from investments or have you done any investments? So that would be investing activity, right? And apart from that, if let's say you have raised a loan to buy a house, that would come under finance activities. That's the analogy to remember, at least in terms of the three financial statements that you should never forget. Now we can come into how do we identify, and I'm going to show you a template which you can download, basic questions which will tell you whether to put this into an income statement or whether it will go into a balance sheet, right? So let's get right to it. So starting with the first transaction, okay, and now you don't really need to remember anything. You really also do not need to focus on saying that, okay, I know income. So you have to come as blank as possible while dealing with this. That will clarify things for you in the longer run, okay? So let's say you started a business with an initial capital of 50,000. The first thing to understand is, or to ask yourself, the first question is, will this capital get consumed in the business in this current year itself, right? Doesn't seem so, right? Because you start a business with, let's say, some capital, you tend to use it over time. So if the answer is no, that means it is not going to come in your income statement, because income statement is related to a particular year, right? And first of all, 50,000 is not even income, right? Now let's ask the second question. Is it related to core business? We don't know, right? So don't know at the moment because we've just put in the capital, right? Now, did it happen in cash? Of course, we got the capital in cash. So yes. So the first thing is very clear that this goes into the balance sheet. The reason is because it is not going to get consumed in a particular year and it's going to be used in multiple years. So in the form of equity, okay, don't get bogged down with this concept of equity. All it means is your own money, okay? So equity is where it will land up in the balance sheet, right? It can also be called as contributed capital, but these are just synonyms for the same thing, right? Now you bought a machinery worth $10,000, okay, with a life of 5 years. Okay, now again ask the same question: will it be consumed in the current year? Well, you can't really use the entire 5 years life of a machinery in a single year. It's not just possible, right? So hence, of course, it's not going to be consumed in the current year, but part of it will be, right? So how much part? 1 year. So worth 1 year of the machinery will end up in the income statement because it relates to this year, right? Remember, the income statement is income and expenses report. Okay, it's not just income. So is it related to core business? Yes, of course, because you buy machinery related to the core business itself. Did it happen in cash? Well, we don't have any information regarding it, so we will assume that yes, it did happen in cash. So what will come in the income statement? The 1 year worth of the machine will come in 1 year. So that means if we were to divide 10,000 by 5 years, so that means $2,000 worth of the machine is getting is getting shown in the income statement, while the rest of it is left out here, right? So that means if 2000 is consumed, 8,000 remains in the balance sheet as fixed assets, and over time this will keep on reducing, right? And in the cash flow statement, well, it's since this has happened in cash and we don't have really any other information, so we'll assume it that yes, this will show up as a negative cash flow. So you have to be uh, very careful. The fact that cash flow statement works on positive and negative numbers. It's cash inflow or cash outflow. And since we bought this machine, right, it means that it's a cash outflow. The question is which part of the cash flow? Well, it does not relate to the core business, right? It is not related to the buying and selling of goods. So it's investments, right? So investments would come in the investing activity, right? Let's take the third example. You bought 2000 worth of raw material in credit payable next year. Now this is where people tend to get confused as to, I have to remember accounts payable account. You don't really have to remember. Just look at the keywords, okay? What is raw material? You can't always write raw material, right? You can also call it as inventory, right? So that means if you bought $2,000 worth of raw material, it is going into inventory, right? But the first question to ask is, will this entire raw material get consumed in 1 year? Of course not, because it depends upon whether you will use this raw material to make a finished good in 1 year, and it has to also get sold. So we don't have that information at the moment, so it will directly go into the balance sheet. So it is not used in the current year. And is it related to the core business? Yes. Did it happen in cash? No. So that's where the another account comes, right? So because it's payable, that means the keyword is payable. So the payment of it will go in the balance sheet in terms of accounts payable, right, as 2000. And at the same time, inventory will also increase by 2000, right? Plain and simple. If it had happened in cash, by the way, so your accounts payable wouldn't have been increased by 2000, right? That means you really don't have to keep a track of who you have to pay next year, right? Because you paid in cash, so your inventory goes up by 2000 and you pay it in cash, so your cash reduces by 2000, right? I'm not even talking about double entry system right now because it doesn't matter at the moment. So the next question is related to that. See, you bought $2,000 worth of raw material in cash. So again, the first question, will it be consumed in current year? No. Is it related to the core business? Yes. Did it happen in cash? Yes. So in this case, right, so this was supposed to be up. In this case, there would be no accounts payable, but your cash, since you paid with cash, right? So your cash goes down by 2000, right? So those are the two transactions that happen at the moment, right? So you see how it's going, right? Now this is where it becomes interesting, right? So it went into the balance sheet because you were not going to consume it today, right? And you kept a track of it. But now you sold $1,000 worth of raw material. You finished it, you made a new product out of it, and you sold it for 5,000 in credit. Okay, so the question is, how much of this inventory was first of all consumed in the current year, right? So it's pretty clear that it is the part of current year. So that means yes, right? And even the $5,000 that you earned is also part of this year, right? Is it related to core business? Yes. Is it sold in cash? No. So then in income statement, what will come? So in income statement, even if your money did not come in cash, your revenue will increase, because revenue is not necessarily cash, right? And at the same time, the cost of goods sold, the inventory which you converted into raw material, now comes up as $1,000 in the income statement, right? Which means that in the balance sheet, okay, first of all, taking care of the revenue because you've sold in credit, that means people owe you, so you are due to receive, which means accounts receivable, right? That's all that means, right? So you're going to receive 5,000, so I keep it as $5,000, which you should keep a track that, next year you have to go to the customers and take the money back. And at the same time, cost of goods sold, since you have now used part of the inventory, that means your inventory now will go down by 1,000. So initially it was 2,000, so now it is 1,000, so it will come down by 1,000 to as the inventory which is left. Now if, let's say, again, now you sold 1,000 worth of raw material, the only thing that's going to change, okay, is that it did happen in cash, right? So if it happened in cash, then your revenue is same now, because whether you received in cash or whether you didn't receive cash, revenue is revenue, right? So you got the revenue. Your cost of goods sold is also pretty same, but in case of accounts receivable, now you will not get accounts receivable because you got cash, so there's nothing to receive in the future, so you get cash as plus 1,000, right? Sorry, 5,000. And now since you have also consumed the remaining inventory, now you are left with zero inventory, right? Now last entry, got advance, okay, of 5,000 for goods to be sold in second year. So the first question, now this is where it becomes valid, right? Is it consumed in the current year? No. So if it is not consumed in the current year, it should not come into my income statement. Is it related to core business? Yes. Did it happen in cash? Yes. So that means in income statement there is zero entry, because you're getting advance for the next year. So if you're talking about next year, it comes in balance sheet. But now where do we put it? Since it's advanced income, right? So you have liable to provide service in the future. That means first of all, it has to be a liability, right? So it will be, you can call it different names. You can also call it as deferred income of 5,000, I believe. That's what the number was. Yes. So deferred income of 5,000, and since you received it in cash, your cash also increased by $5,000. So plain simple logic of asking three questions on deciding which statement is going to be used, right? So that you don't really have to remember, cost of goods sold has to go here, inventory has to go there. It tends to confuse. This is the basic logical to be used in deciding which financial statement is to be used and where the entry has to happen and what is the logic of the statement, right? Now we get into the real stuff, creating these financial statements, and in the process we'll also understand the linkages between each, right? I'm going to create a financial statement for Johnny Depp.
That's correct, sir.
Right? So Johnny Depp has been going through a lot of crap recently, so we will create a financial statement for him. In fact, you can create a financial statement even for a normal person, for yourself, right? It doesn't really matter, but you won't do that because it's too much work and plus we don't really have to report it to anyone, right? So anyways, let's start with, again, do not remember anything, just use logic. Okay, so Johnny Depp started this year with a movie which fetched him $1 million, right? 50% of it was paid in cash and the rest will be paid in 2022. The secondary information that we have is the total travel cost for the same. That means the cost directly related to generating that revenue is $100,000, right? So first of all, in case of the $1 million, the first question which we asked in the previous slide which you learned is it related to current year? Yes, it is. So if it is related to current year, then I'm going to put that as 1 into 10 raised to 6, because million has 6 zeros, right? So 1 million worth of revenue has been generated. Whether in cash or not cash is the secondary question. What is the direct cost we incurred? We incurred a cost of travel, which is $100,000. Okay. Now we have to take care of the secondary information that 50% of it was paid in cash. So what I'm going to do is I'm going to put in 2021 1 million, okay, into 50% in cash, right? So he got in cash, but now somebody owes him next year, which means accounts receivable. So 1 into 10 raised to 6 into 50% comes up out here, right, in the balance sheet, right? So I'm gonna add up, all the relevant values, and don't worry about this at the moment, but you'll get it as we keep on solving it, right? All I'm going to do is just keep the sum up here so that we keep on calculating this. Okay, and I'm going to create a checksum here. It just tells me whether by how much it's not matching, it's matching, so we can always keep on correcting if there are any errors. Right now, of course, the balance sheet does not tally because I haven't done the calculation here, right? So this is COGS, cost of goods sold, for generating that 1 million. So at a gross level, how much did Johnny Depp earn? So at a gross level, he did earn $900,000, right? Indirect cost we don't know at the moment, so let's calculate earnings before interest, tax, depreciation, and amortization. That's a big mouthful, but all that means is we haven't considered all the other costs. So what is the earning before that, right? Depreciation we don't know at the moment, so whatever is blank, I just leave it and keep on calculating the line items, right? So EBIT, so depreciation is gone. Now what is left is EBIT. I reduce interest, I get EBT, and tax I will calculate as 30%, okay, and PAT will be EBT minus tax. All right, so now this PAT is what finally I have to keep a track. Johnny Depp has to keep a track. Okay, this year I have earned this much, I need to keep a track of it, right? So what I'm going to do is I'm going to link this to retained earnings. It's the same as savings. Okay, after paying for everything, how much are you left with, right? Now you see what exactly is happening out here, right? So you saw that 1 million in cash in revenue, out of which 50% you got it, and 50% you did not get it because you will get it tomorrow, next year, right? Now in terms of cash, we also will reduce the taxes because taxes are assumed to be paid in taxes in cash, right? So there's your 7,30,000 out here, and we also need to reduce the travel cost that we incurred, which is 100,000, right? So there you go, 100,000, right? So now your balance sheet is tallying at the moment, right? So now let's look at the second entry, what he spoke about. Okay, so he started a production of an upcoming film, okay, which cost him total production set cost of 200,000, which was brought using a loan of 50% with an interest rate of 5%. Now don't take all the information in one go, let's take it step by step. So the first information that we have is that the cost of production is 200,000. That means he bought some assets to create revenue. Now let's stick to what we know. Is it related to only the current year? No, only probably 1 year worth of it is actually going to get consumed in the current year, right? So let's go to our balance. That means we have to go to the balance sheet. That's all I mean to say, right? So 200,000 worth of fixed assets which we purchased, right, is going to get consumed only 1 year in the income statement, right? So how much is it? So that, I mean, at the moment all that means is divide that by, let's say, 5 years. If you're talking about 5 years, then I'm just going to take 5 years as the depreciation. I don't think so that information I have put in here. Okay, so I'm going to assume that it's going to get used 5 years. So let me depreciate it. Okay, so depreciation is the same thing as how much is it getting consumed in 2021. All right, so I put this depreciation out here as 40,000. Okay, there you go. So now your assets which are finally left in 2021 is 2 lakh. minus 40,000. Right, there you go. Now, you can see that the balance sheet does not tally. So, let's look at what exactly happened. Since your fixed assets went up by 200,000, right, and it was paid by 50% loan and 50% cash, because we have not considered that, that is the reason why the balance sheet is not tallying. All right. So first, let's take care of the 50% of the payment which was done. Okay, which means that 100,000 was paid through cash. So the cash went down by 100,000, right? And the remaining amount came through loan, which is also 100,000. And there you go, the balance sheet tallies. But now we also need to take care of the fact that there's an interest cost which has to be paid of 5%, right? So now again, ask the question, is the 5% interest of the loan related to current year? Of course it is, right? Because you don't really pay interest for 5 years all at once. You pay year by year. So what's my interest? So my interest is going to be 5% multiplied by the loan, right? So what's the loan? The loan is 100,000, right? So 5,000 is the interest. Now the balance sheet does not tally because of course we need to pay it through, right? We have to pay through cash. So let's reduce the cash by 5,000 of interest, right? There you go. And the balance sheet tallies, right? Now let's go back and let's look at the third transaction. He has multiple houses which fetched him a rent of 1.5 million annually with a direct cost of maintaining at 10% payable in cash. So first of all, he got an additional revenue of 1.5 million, right? He's a rich man, he turns on the law of rent. So 1.5 million, 10 raised to 6, there you go, right? A lot of money. And in order to generate this, he incurred 10% of the 1.5 million. Okay, that's all I'm doing. 10% of the 1.5 million as direct cost, right? And at the same time, now the revenue also has to increase because you receive the rent in cash. So 1.5 into 10 raised to 6 was received in cash. And since 10% of it was paid in maintenance, I'm just going to take 90% of it, right? There you go. And the balance sheet tallies again, right? So we are halfway through Johnny Depp's financial statements. Let's continue. Right. Johnny Depp has a total staff consisting of bodyguards, lawyers, cooks, maids, costing him 200,000 annually. Lawyers for all the not so popular reasons. Anyways, 200,000 is what his indirect cost is. Now, this is not really a direct cost because these are staff which are required for him not to really generate revenue, but probably indirectly, probably making sure he's alive, right? So in that case, this becomes indirect cost because not related to directly generating the revenue. Because directly generating the revenue, since he's in the service industry, he needs to travel, act, and for that there's no actual cost apart from traveling cost or maybe staying cost. But the staying would be paid anyways, right? So indirect cost of $200,000, right? Now that is payable in cash, right? Nobody really takes credit in terms of the salaries. So let's reduce the cash by 200,000. There you go. Balance sheet is tallied. Now you might be asking, how's the balance sheet tallying? Because when you put 200,000 out here, your PAT reduced by 200,000, right? And where does the PAT go? The PAT goes in savings. So that means savings also reduced by 200,000. So your liability side went down by 200,000. And at the same time, your cash went down by 200,000 and hence the balance sheet tally, right? So that's the logic. Now, Johnny signed a new film for which the producer gave him an advance of 0.5 million in cash. All right. So again, asking the basic question, is it related to the current year? No, it's not. It's an advance. So if it's an advance, it goes into the balance sheet. But will it be an asset or a liability? Liability, because I can't just take away the cash and run away. I still have to provide him service, which means acting for the film. So hence, I'll have to go to the liability side in advance income and put that $500,000 so that I remember that I have to still live up to what I have committed. And at the same time, we can't deny the fact that it was received in cash, and hence the cash received increased by 500,000. Right. So far, so good. I think we left with probably only 2 cases. All right. Now, John is going through a defamation case. Probably you're pretty aware of it, and but the lawyers are not sure whether they will win. Okay. Now, of course, the news is that he's won. But who knows? There might be a new petition which might be filed. In case he loses, he might have to shell out close to $1 million. Now, what do we do with such cases, right? We know that every financial statement should ideally show the true picture, right? We don't want to come across a company which is going to 10 cases and suddenly one day, the suit is lost, and then there's a huge loss which comes into the income statement. So what we could do is we could take that 1 million, right, and put it into provisioning. That means maybe a part of it we can put it in this year, and the part of it we can take it as an expense next year. Okay, and in case we win, we can take it as a profit, right? So what we will do is, since it's a liability, right, so I'm gonna create a section of liability which will be called as provisions. So I'm just creating provisions for in case I might take a loss one day on this case, right? Anyways, so that's provisioning, and let me sum up that as well. Now, of course, the balance sheet of course doesn't tally because there has to be a counter entry to this, right? Now, not necessarily this is in cash, right? So what I'll do is just before EBT, okay, I'm just gonna get provision. So in this year, I'm provisioning 1 million. Okay, that's all that means. So it will be taken as an expense. We will reduce the 1 million. Okay, so that's gone into provisioning. This is the tax after the provisioning, and this is the PAT which is gone. So the liability side is already taken care of. Okay, by putting into provisioning, and of course through the income statement in retained earning, the provisioning counter entry is already come, and hence the balance sheet is tallying. Alright. Okay, so the last entry, he has made a mutual fund investments worth 500,000 in 2021, but at the end of the year the markets crash, he lost 1,50,000. So investments, again, are you going to use the investments only in the current year? Of course not. Investments are for multiple years, so it directly goes into the balance sheet, and it goes with the value of 500,000, and the cash should reduce by 500,000 because we paid it through cash, right? And the balance sheet is so far, oh, did I put the wrong number? 50,000, okay, 500,000. So the balance sheet tallies, and now we made a loss. But now you have to understand, the loss has not been made in cash. The loss would be made in cash if I withdraw the amount, but it's just happening in that mutual fund account. So I'm not really facing that loss in terms of cash. So the cash will have no bearing to that. But of course there's a loss here, so we have to show it in the income statement because it relates to the current year, because the loss was made in the current year. So loss in investments, I'm just using normal language, okay, so that you understand. So 1,50,000 worth of losses were made. Okay, so that means it will reduce the profit after tax and indirectly also reduce the retained earnings. But what about the counter entry? The counter entry is simple because your investments are liquid investments, so it has to also reflect on the losses that we have made. So we did create the income statement balance sheet, but we did create the balance sheet pretty manual. Okay, now I'm gonna try to get the cash value. Okay, so where's the cash value? So cash value is showing as 1.188500, right? So we're going to derive that using directly the cash flow statement, and that's where you will appreciate how much work actually is getting done by the cash flow statement so easily. Okay, so let's link the net income, because we start with net income because you claim that this is what you earned. Now let's see whether you earned this much in cash. That's the question we're trying to answer. Okay, now we're going to add the depreciation because you really didn't pay for depreciation, right? I mean, did you pay it with cash? No, of course not. So let's add that back because it was just reducing, right? Also the loss. Okay, there are a few entries that I'm going to put it out here. So loss in mutual fund and the provisions as well, they were not really in cash, right? So since it has reduced the net income, we're going to add it back, because remember, what we're trying to do in cash flow statement is to find how much did you earn really in cash, right? So loss in mutual fund was how much? 1,50,000. So I'm just going to put that back. Provisioning, we provisioned, but we really didn't pay it in cash. All we did is just create an account. Now changes in working capital, which means that your receivable is 500,000. That means you did not really get that in cash. So we will put a negative value. That means we want to reduce that income by what we did not receive in cash. But at the same time, in the advance income, we did get the same amount in cash. So that means net, the changes in working capital, right, is going to be zero, right? So that means at an operating level of my work, okay, I've earned this much, right? How much does this look like? Let me just show you in terms of millions. So 0.17 million, that means about 1,70,000 odd value, right? Now you did purchase the machinery worth 200,000, right? So it's going to show it as that negative. And plus you did make an investment of 300,000 or 500,000, right? So I'm going to show that as well. So my total investing cash was about 700,000. We did take a loan as well, right? So it's not home loan, but we did take some loan. So the loan which I took was 100,000. Okay, this is a loan, by the way, not home loan. So I'm just going to change that. And we did infuse the business with about 50,000 worth of equity at the start, right? By the way, my equity is not seen here, which was supposed to be put. Oh, did I put equity? No, I didn't. Oops. Sorry about that. So there's no equity, all right, at the moment. So loan of 100,000. So total changes cash is cash flow from operations, cash flow from investing, and cash flow from financing, right? So that's about 118,8500, right? Cash at the beginning, we had nothing, zero, right? So at the beginning, whatever we had plus what we made this year. So if you see, the cash value out here and the cash value out here matches. Okay, so let's summarize, okay, how these three financial statements, you have indirectly actually linked everything without realizing it. Okay, so if you see, revenue is related. So if I just mark here, revenue is related to your cash accounts, it is related to your accounts receivables account, it is also related to your advance income account, right? Invariably, right? Cost of goods sold is linked, if you see, to your inventory, right, which at the moment we don't have. It's also related to your accounts payable, which also we don't have because we are not really producing any goods, right? And also in the indirect cost, if you are also not paying the indirect cost directly, I mean in cash, then there can be accounts which might be created in the balance sheet. Okay, depreciation is related to your fixed assets, right? Plain and simple. So this is related to this, right? Then you've got interest, which actually is not related directly, but it does get used in the calculation of how much cost you're bearing for the interest, right? Your investments, of course, related to your investments account, right? And your PAT is actually linked. I hope you can figure out. It's related to retained earnings. There you go, right? And actually, in practical life, this cash is actually not created like this. It is too tedious, right? So this cash is actually derived from here. Okay, so maybe I'll use the same color so that you understand. Okay, so this cash actually in the cash flow statement at the end of the year goes directly and gets calculated out here instead of you calculating manually. So you make all the balance sheet entries separately, okay, but then your cash value actually comes from the cash flow statement, right? So I hope these three financial statements are clear to you, at least with the Johnny Depp example, right? And I think this is the kind of practice you need to do if you really want to remember the three financial statements easily. Because if you are taking very complicated, I'm making a financial statement for Tata Steel, half of the business terminology is not understand, right? Hence it is very important for you to take simple examples like this. I mean, just create a financial statement of yours own, right? And that will put your brain into use, because you will be able to relate with the transaction. The important aspect where a lot of people fail is the fact that most of the time we don't understand because we can't relate to it. So use examples which you can relate to. Like, for example, just make your own financial statement. You will be able to relate to each and every transaction. You'll ask yourself the question: where should I put this? Is it related to this year? Is it related to the current year? Is it related to something which I owe or somebody owes me? Right. So that was the three financial statement linkages. A simple tutorial. I hope you understood the concept, and if you do have questions, please put it on the comment box, and I have to solve that. And probably I'll come back with another video next time. Bye bye.